My name is Nancy Wallace-Lobbs, and Foreclosure Daily, I've been a client of theirs for quite some time. And they're all about connecting buyers with motivated sellers since 2004. I'm also the founder of Money Making Mamas. I'm seeing, there we go. Who are Foreclosure Daily? Well, they are a nationwide lead provider. They provide leads to investors, realtors, attorneys, and just your basic first-time buyer. They've been in business since 2004, and since then, they have been the internet's #1 destination for the most detailed and timely information. And I could speak to that because I'll talk a little bit about how I use them. So as I said, my name is Nancy Wallace-Lobbs, and I've been a real estate investor since 2006. I'm also a Texas broker, former property manager, national speaker, and a best-selling author. And my daughter and I, Kelsey, we founded Money Making Mamas and the Millionaire Mama Method to help busy families contribute to their household income without sacrificing family time by investing in real estate. I have been a client of Foreclosure Daily since 2018, and some of my best and most famous deals come from the leads generated by ForeclosureDaily.com. The students we mentor love these leads and find them easy to get deals out of all the list companies out there. Foreclosure Daily has the best and cleanest leads around. And I've used a lot of list brokers over the years, and I can tell you that once I found Foreclosure Daily, I never went anywhere else. So there's my contact. And hey, do a small business a favor and give us a follow on Instagram at Money Making Mamas. Now, the Millionaire Mama Method Masterclass is we just give you the skinny about investing in real estate. And I'm sorry, my dog's barking there. We debunk the myths, and how this all came about is that my daughter decided not to return back to work after she had her second baby. So in the Millionaire Mama Masterclass, we give moms and families the knowledge and confidence to start investing in real estate. And you can, click on that QR code to find out more. Now, how are Foreclosure Dailies different? Well, their leads actually have real estate attached to them. And I can tell you from experience, I've used list companies that don't. They're delivered daily, weekly, or monthly, depending on the type of lead that you're getting. The property appraisers information on most data types. Most companies that we found are quarterly and are not farmed for real estate, and I can speak to that. And Foreclosure Daily really understands the importance of having fresh data that is farmed for real estate. And so I use their pre-probate leads, and they are awesome. So the types of leads they have are probates, pre-probates, absentee owners, divorce, distress, code violations, evictions, inheritance, auctions, tax lates, I probably didn't even say that right? Cash buyers. So they have all kinds of leads for you. And then they have bonuses. So when I first started with them, they told me how to market to the pre-probate leads. And the way they told me to do it just worked. And now you can actually, they partner with direct mail, and you can get all of these cool postcards. And I have used some of my most famous deals. I've used these postcards. The one that I love the most is the one with the red, get the cash offer. And when you're competing in the investor space, you kind of have to stand out. So you do have to try different types of marketing. So Foreclosure Daily actually gives you all of these different formats. And in addition to that, you can do, handwritten letters. So it depends on your style and the list that you're going after and how you want to market. So I'm a very direct person, very simplistic. So handwriting wouldn't work for me, but if it may work for you and the type of leads that you're going. So if I was looking for listings, I'd probably use this type of handwritten letter. And then you can also, they have a personal touch. So you can actually have the service where they create the marketing by hand, and you're going to get a special discount with that. And they're going to create the marketing piece, send it out, and you just wait for the phone to ring. So it's all done for you. Now, in addition, this was very helpful when I started with Foreclosure Dailies. You're going to receive a book from Kevin Sales on probate real estate sales 101. And this is great if you're a realtor, if you're an investor, because you're going to not only get this book with it's just chock full of all kinds of ways to market, what kinds of things to say to people. You're going to have access to the webinars that the author actually puts together in every month. Now, tonight we have a real treat. We have Greg Emmer from Equitymax, and he's going to help you finance your real estate deals. And he's going to talk to you all about how you can get money from him. So he's going to present on how newer seasoned investors seeking financing other than banks. And if you've bought more than one property, you need to know somebody like Greg. He's a private money specialist for real estate investors. And Greg has been referred. He's such a good partner with Foreclosure Daily that they have referred him to their clients on and on. So I'm going to stop my share and I'm going to have Greg come in and he's going to start talking. Just bear with me a minute here. And Greg, here comes Greg, and he's going to present for you. So take it away, Greg.
Hello, everyone. Let me just share my screen. And there we go. Can you confirm that you can see it, guys? Okay. There we go. Okay. So first off, thank you for having me. Thank you to you, Nancy. Thank you to Tangi and Joe. For those of you that have used Foreclosures Daily for a while, you guys certainly know Tangi and Joe. And I don't know how many people are on this webinar, but we're going to talk a little bit about hard money, private money in general. We'll talk a little bit about what we do specifically as a company, and maybe there's a fit to work with some of you out there. And then last but not least, where on earth is this market going, right? Obviously, over the last 2 years, things have changed dramatically. Where are they now, obviously, versus then? And just one person's opinion, myself, where do we think they're going? So we will now move. Now everyone can see the who is Equitymax slide, hopefully. That's us, obviously. We're a family-owned and operated company since 1990. I've been doing this since about 2002, so over 20 years, 22 years. We specialize in hard money and private money. We only lend our own family money. So, we're a private money lender in that regard, but we have the scope of a larger hard money lender, given that we lend in 47 states. The states we don't lend in case anyone out there is wondering, South Dakota, Vermont, and Utah. So otherwise, all other states, we will finance your fix and flips or your refis. And me personally, I have used Foreclosures Daily before. I used it in an attempt to buy my first home for primary use. And you can ask me later on if that was proven successful. Moving on. So in a general sense, let's talk about what a hard money lender will ask for. There's two different types of hard money lenders. There's one, and a lot of people will say, oh, hard money lender is strictly asset based. Well, that's not necessarily the case anymore. Believe it or not, there's almost been a coming together of what previously was traditional and soft money, and then what was hard money. Now there's something almost in the middle. Sure, you have the traditional asset-based lenders, but more so, I think you're associating hard and private money with those financing options that are backed by institutional partners, meaning the money's coming from Wall Street, money's coming from private equity firms. Big hordes of cash are being given to these smaller hard money lenders who are subsequently lending them out. So as such, and given that it's tied to Wall Street, they're going to ask for things that a normal asset-based lender, strictly asset-based lender, will not ask for. Okay, just some of the things: a formal application, bank statements, usually the last 2 months. They definitely want to know your experience. If you're asking for rehab money, they want a construction schedule, a draw schedule, what work you're going to do, in what order you're going to do the work. They want to know information about your contractor. They want to know your contractor's experience. They want to make sure that they're licensed. Each subsequent month where your deal does not close, guess what? These lenders are going to ask for more bank statements each month and make sure they're updated in their system. Yes, they're going to require a full appraisal. Yes, they're likely going to require a survey. And if all things go according to plan, 4 to 6 weeks later, you'll be able to close. I've found that unless you're a repeat client under these circumstances, you're never going to be able to close in less than a month. So always ask, and we'll get into this later, where your hard money lender is getting their funds from. They may call themselves a direct lender, but if it's not their own personal capital, that means they're answering to a higher power, a boss, a committee, whatever you want to call it, and the process will likely take longer. Now, by comparison, our company, Equitymax, who is a more traditional asset-based lender, what will we ask for? On a purchase, we'll ask for a copy of the contract. If you don't have it under contract, we'll want some basic information on the property so we can look it up. Obviously, we want to know what you're paying for it. If it's a refi, it's very important. We want to know what you paid for it and when you bought it. Obviously, to ensure that you still have some financial skin in the game, invested in the transaction. And if you bought it for 100,000, for instance, and it's worth 500,000, we're not just giving you a boatload of cash to do whatever you want with. That's how a lot of lenders made mistakes back prior to 2008. And obviously those lenders don't want to make the same mistakes over again if they're still around. We're one of the few lenders actually that made it through the Great Recession unscathed. We continued lending throughout, and here we are, still standing. While we are mainly asset-based lenders, we do want to know what your scores are for your credit. We don't have a minimum credit score requirement. Other lenders, other hard money lenders that I previously spoke about will have a minimum credit score, I think probably around 600. We do not, okay, but we're not going to give a person with scores in the 700s the same terms as someone with scores in the 500s. Someone with lower credit's going to have a lower loan to value, potentially a higher rate, more points, etc. All because it's a riskier deal if your credit's not so good. Generally speaking, again, grouping these hard money institutional backed lenders with a company like us, Equitymax, what will those institutional lenders finance? Generally, it's your run-of-the-mill single family 1 to 4 multi-unit residential properties. It's got to be in a metro area or just outside of a metro area. A steady and robust population with ongoing growth. And again, loan amount seems to be an issue where there's a hard stop at 50,000 minimum. Some lenders I found have minimum loan amounts of 75 and even 100,000. So when you're talking about a purchase of, let's say, 80% of the purchase price and the minimum loan amount's 100,000, you got to look at purchases of at least 125,000. Hey, what happens if you're buying a property that's less than that? We'll talk about that in a few minutes. Again, these lenders generally want to finance structurally sound properties, block homes, brick homes, stick homes, and they want them to be seasoned properties and seasoned investors. No less than 2 to 3 seasoned properties on a refi, having owned it about 4 months before you're eligible for a refinance on a DSCR loan. So what will Equitymax finance in comparison to the other lenders? Basically, everything that they will do, we will finance. But what we found is that there's a growing market out there, okay, for properties that do not fit the typical box, if you will, of real estate transactions. And those are ones that we are gearing ourselves towards financing over the last 2+ years. So what are some of those properties? Generally, they're ones that the institutional lenders just will immediately deny and not look to finance. Properties in rural areas. This could be a home in a rural area on a 1-acre parcel of land, or it could be a single family home on a large plot of acreage of 50 acres. We'll find value in it regardless, even if it's in a rural area, no matter the property, we'll finance it. Our minimum loan size is only 15,000. Again, 15,000. So that leaves you with a much larger scope of properties that you can tackle. And some of these, either rural areas, even metro areas. I'm talking about Cleveland, Detroit, St. Louis, other parts of the country. You'll find that there are a lot of properties where you have smaller price points of purchases at under 50,000. And that's something that lenders won't generally touch, but we will. And we will give you opportunities to finance deals on properties that may not be worth in aggregate a lot of money, but there's still, there's still profit to be had, whether you're renting it out or whether you're going to fix it up and flip it. Something else that we'll finance that other lenders will not are manufactured, modular, and mobile homes. The one caveat to this is they need to be on deeded land. They need to be affixed to the property, so they can't be on leased land or in a mobile home park. Okay, they can't be considered chattel, which is basically a structure that's on a piece of property that's tangible personal property. It needs to be part of the real property assessment of that county. And you'll find that a lot of people now are buying modular homes as investments and putting them on parcels of land, affixing them, connecting them to generally septic and well water, and they're making them viable real estate investments, either as rentals. If it's in a more rural area, I've seen Airbnbs pop along in modular homes, and certainly for flips. Flips, not necessarily newer construction, but definitely older modular construction homes that were maybe built in the 70s or 80s are being fixed up and then sold for a profit. Also, a couple other types of properties that we lend on are inherited or immediately deeded properties. We find a lot of, this actually ties into something that Foreclosure Dailies does. They do a lot of probate and divorce leads. Obviously, if these people do not sell to you, those individuals could come to us and say, hey, I just inherited this property. If I'm not going to sell it, can I get a loan out of it? And the answer is, with Equitymax, they can. And also, if it's a property that is on the verge of being completed, we have a lot of deals where it's a new construction home. A borrower has already owned the land and is building it using their own money. If they get stuck along the way, maybe a change order from their contractor, or obviously in today's market, materials have gone up from when they were a year ago. That could cause a little bit of a capital shortage for the investor, and they could then come to us for a small loan or large loan to finish up the build. So for a lot of you fix and flippers out there, one thing that is constantly a component of your loan is the rehab and the rehab budget and the rehab money. And oftentimes we've seen borrowers either, well, not often, we've seen them either take the rehab money or not take the rehab money. And what I've found more often than not is, after an initial loan where a borrower has taken the rehab money from a lender, believe it or not, it makes them less likely the second time around to take that money, rehab money, if offered, from a lender to rehab their project. Generally, that lender is going to require bank statement verification, that you have the rehab funds to complete the property, even though they're giving them to you. So it's an extra layer of verification to check on your liquidity. They're generally gonna monitor and approve and even tinker with your draw and rehab schedule. For instance, if you're putting a new kitchen and new flooring in all the rooms and leaving one room out because the flooring is updated, but it's not brand new. Well, hey, that lender may make you change that flooring and make it brand new to be, like the other rooms in the house. So that could potentially add to the rehab budget. A lot of them will charge interest on the full loan amount, which includes rehab money that you have not even taken out yet in draws. So that's potentially adding to your costs on money that you don't have access to yet in the loan process. Every single time you get a draw, they're going to charge you money to either wire it out to you or inspect the property or hire, the appraiser to go back out there and make sure the property is still of proper value to release your money. And also, money doesn't just change hands immediately. Sometimes I've heard horror stories of 3 to 5 day processes to get money released from a lender. And if you're looking to pay your contractors or you're looking to continue with the work and you're reliant on that money, that could cause your project to just take longer than it needs to. My suggestion is if you don't have the rehab money on your own, and that's always, in my opinion, the best option, you could always obtain funding from a JV partner or a secondary lender who's a private lender. And maybe they'll charge you interest, which will be due when you sell the property. Or maybe if it's a JV partner, they'll take some profit participation where you're not charging them interest. Overall, doing it that way leaves less cooks in the kitchen, if you will. You're not having a lender or someone that is on the loan side breathing down your neck and telling you how to do your project. All right, you can always raise capital from family and friends. And in my opinion, working your rehab this way, as opposed to getting your rehab money from a lender, is going to make you finish your rehab quicker and sell your property quicker. And as we'll discuss in a few slides, time is of the essence because, who knows where the market's going to be 2 months from now, 6 months from now, with the election hanging over us. So if you have a property that you're in the midst of building and rehabbing, time is not on your side. I'd get it done sooner rather than later, in my opinion. So what a lender won't tell you that you should be cognizant and aware of. And these are questions that you can directly ask them. And I encourage you to ask them. If you ask us, we'd answer you truthfully and honestly. What is their experience? Our experience, we've been around almost 40 years. What is a lender's financial capacity to fund not only this deal, but future deals? Because you don't want to work with a lender, in my opinion, that will do one deal and then won't have enough money to lend you on another one. Being a real estate investor and a successful real estate investor is based on, in my opinion, the ability to do multiple deals simultaneously, multiple deals a year, being able to scale your operation beyond just doing one deal at a time. And you want a lender that will be there, that when you go to a property and you're doing a walkthrough inspection, before you put it in an offer, that lender is going to be there and you have money waiting for you from a viable financial source. Okay. Where does a lender get their money from? Again, this tells you a lot about a lender's financial capacity, how quickly they can potentially close, and their ability to grow with you as you grow. If they're getting their money from an outside source, that the process ultimately is going to take longer than if it was their own money. For instance, as I told you before, other lenders take 4 to 6 weeks to close because it's not their own money, it's outside institutional capital. Equitymax, on the contrary, since it's our own family money, we can close in as little as a week if we need to. So where someone gets their money makes a difference, and makes a difference in the speed in which they can close. Also, what happens to your loan after it closes? Is the loan packaged together and sold off? Is it held in-house? This is important because some of you, I don't know who, but some of you may like to deal with the same people from beginning to end. And if you have a lender that's servicing your loan, you know that that person that you speak to when you're ready to close the loan is going to be that person that you ask for a loan payoff. Whereas a lot of these institutional lenders, they end up selling their loan and you're dealing with a company that services 10,000 loans just like yours. And you're just another number, as opposed to having an interpersonal relationship with your lender, which goes a long way, I think, in building rapport and again, building that relationship with your lender so that when you need something, they'll be there for you, and vice versa. So this is kind of what I was alluding to in a few slides previously. Where do I see this market going? Again, this is all speculative. This is all my opinion. I was discussing with Nancy before, and obviously I discussed this with my colleagues in the market that I speak to day in and day out. What on earth is going on in this real estate market? Because right now, a standard FHA loan, for instance, is what, in the 7s, and 2 years ago it was in the 3s. So a lot's changed. Obviously, the higher interest rate environment is making hard money and private money a little bit more attractive, just because the gap between hard money and soft money you can get at traditional banks is a lot less than it was in the past. And that, coupled with the fewer requirements that hard money typically has in relation to traditional banking, makes it an option that a lot of investors are looking towards that maybe they weren't 2 years ago. I was discussing this with Nancy. When will rates drop? I don't know. It's funny to hear anecdotes and opinions from colleagues, because after what's happened in the stock market over the past few days, people are saying, "Oh, drop rates, drop rates, drop rates." But in my opinion, inflation, not in my opinion, but historically, inflation is still on the rise. It's on the rise at a slower clip. And I think until that inflation, until prices are going down, and until maybe there's a lag in spending power and spending in general, I don't see rates going down. And even if they did go down in response to immediate events that happened currently, like stock market drops, it's not like they're going to go down from 7% to 3% overnight. Maybe we'll see a drop of 1/4% or 0.5%. In my opinion, it's not going to be anything that will fluctuate the market on a grand scale. I think it's more for morale building and to temper any angst that's going on amongst consumers and investors out there. So in general, because of all this, obviously we've reached a new normal. And I think without the craze of post-pandemic spending, there's been some stability in what to expect in today's market. And I think a few things come into play that I've seen develop over the last 6 months. One is longer listing windows. Okay. Before you put a property on the market, you had 6 offers the first day, or so, then it became 6 offers in the first week, then 6 offers in the first month. Now you're seeing 6 offers over the lifeline of a listing. And that listing, instead of going 1 week, 1 month, it's going 6 months. So definitely longer listing windows, fewer offers. And if you look at the data, and I'm a real estate broker as well, so I have data to the MLS, and you will, and even if you look at, well, not Zillow won't have this, but if you look at MLS data, if you're a real estate broker, a real estate broker, you'll see that the final listing, not only, this is just based on the final listing price, but generally speaking, I found that final sales prices are about 10, 15, sometimes even 20%, if it's a distressed situation, 20% lower than the final list price. And that doesn't even include had that list price been higher when it first hit the market. So always know that if you see something listed for sale, if you're a buyer, that it's likely going to sell less, and that gives you some bargaining power to offer less. So if we are headed in towards a downturn, or if we are headed into a new normal, kind of this plateau in the market, what are some tips to succeed? Well, if this is plateauing and if, market prices aren't going up anytime soon, if you're looking at a property that's a flip, always cross-check the rental potential in a case where, maybe the credit markets dry up and your exposure on it is too high where you can't sell it for a profit and maybe you're going to have to rent it out. Okay. If you're in a particular market where there's not a lot of activity, obviously, or not obviously, but the obvious step would be look to another market. For us as a lender, we first started lending in South Florida. Then it became very competitive, not as many opportunities. So we moved to other parts of the state. Then we moved to the Southeast, and now we're a nationwide lender. So this didn't happen overnight, obviously, but looking for opportunities outside of your comfort zone is what will help you succeed as an investor. And depending on what scale you invest in, if it's local, regional, statewide, or national, make sure you have experienced and tenured professionals around the country or around your market that are going to be around. You want to find a contractor that's been around 20 years, not that has been around since the market got hot in 2012 from the Great Recession, or more specifically, 2020, 21 during the pandemic. Try and find tenured, experienced professionals that will be around if something were to happen where some of the competition is weeded out. You want those experienced professionals that have been through this before, that know how to adapt to a changing market, because that's definitely what we're in. And that's my 2 cents. If you have any questions for me, you can call my cell phone. That's the bottom number. My direct email is there as well, and you have our pertinent company contact information. We feel our website is a plethora of knowledge, a lot of information that is useful to investors, to realtors, to loan originators, to title companies and contractors. We post new content multiple times a month, so be on the lookout for that. And we send out relevant market-driven data and information and updates via email as well. And we're happy to collaborate and work with anyone that wants to be successful in the real estate industry. So with that said, Nancy, I'll hand it back to you. And ready when you are, if anyone has any questions or you want to continue conversation.
All right. Well, thank you so much, Greg. I appreciate that. And it was a lot of good info. And I think I'm going to bring my screen back up here if that was even. Oops, no. What do I want to do here? No. But yes, well, what we'll do is I'm going to go and grab my screen. Okay, guys, bear with. We're going to do another scare. Okay, yes, I'm going to, there we go. There we go. All right. So I will get better at the techno stuff. So, okay. So Greg, thank you so much. And yes, we're going to go through a couple other slides and then come back to the Q&A. So get your questions in there for Greg. And, here we go. Just got to get the right thing. Okay. So Foreclosure Daily, let's talk about what you get with Foreclosure Daily. So first off, there's all kinds of bonuses. So you get the 6-step mailing campaign, the 6-touch campaign, phone scripts, and email to send to attorneys if you're going to work probate leads. I saw someone ask a question about that. You get postcards and letters, and you could choose, like what I said about your style, that probate book mailed directly to you. You're going to have a special link to receive reduced mail rates, and a special link to receive reduced rates to skip tracing rates. All right. So skip tracing, if you, sometimes I'll run into a property and we don't know who the owner is. We're trying to track it down. And so you need to skip trace it. Webinar training on unique marketing techniques, which is really great. That's where I learned how to do a lot of my stuff through the different marketing and things that I learned from Foreclosure Daily staff. And webinar on the 7 ways to make money with probates with the author who wrote the book. So it doesn't get any better than that when you get the source. Now, Here's the prices for Foreclosure Daily. Now, always make sure you reach out to your representative, and they can go over this in detail more with you. But basically, they got a special. If you contact them by this Friday, so this is Tuesday. So this Friday is like help me out here, guys, the 9th. You're going to get buy one county, get one free. So there's the probates, the pre-probates, the inheritance, the divorce, the code violations, evictions, and that's for each list. And so the pricing is $5.99 for 12 weeks. That gets you one county, and you can add on another county for 50%. $9.99 for 26 weeks. So $1.99 on savings and get that second county for 50%. And then $17.50 for 52 weeks. So do you see a pattern here? The more you buy, the more you save, right? So you're going to save $646 and get that added on county for another county for 50%. And your rep will work with you about the counties that you want to market to. In Florida, the foreclosures are $479 for 3 months, $799 for 6 months. That's 159 savings, or $1,299 for 1 year, for a total of 617 savings. And you can do a la carte for the, such as the absentee, free and clear, tax late rates, and that's about $1,000 for 500 leads. So reach out to your rep, and they can help you out there and help you decide what kind of marketing you can use. I know they were really great. And the more you buy, the more you save. Isn't that the way it goes? The more you buy, the more you save. So you can find out more about me at my website, moneymakingmamas.com. And as I said, follow me on Instagram. Now we're going to go to the Q&A. So someone talked about they would like to learn how to navigate pre-probate leads. That's actually probably a webinar in itself, wouldn't you say, Greg? I will give you a little tip though. So when I first started,
Yes, absolutely.
yeah, when I first started, and this was a few years ago, I will give you this tip. So I got the list and I was so excited, and I did my marketing, and I got some tips from Tangi, and I sent out the first list, and I got a lot of phone calls back, which was good. People were calling me, but it was what they were calling me, right? So the pre-probates are when you get that list, someone has died usually the week, or they're very fresh is not the right word I'm looking for, but there's
Still breathing.
Yeah, there's a certain technique to pre-probates. They're great leads, but you do have to kind of season them and let them, you can't just contact them the day they come out. So yes, Greg says, is this being recorded and sent out? Definitely. I think it'll be up tomorrow on the YouTube channel. So Greg, what happened with buying your house through foreclosures?
So I think what Anna's asking is, what was my experience with Foreclosures Daily? I think if that's the question, I'll answer it. So this was for my primary residence. I used it for about 6 months. I did get some leads, but it ultimately, didn't reach fruition. I mean, I didn't find my house through Foreclosures Daily. I was very limited in the type of house I was looking for because it needed to be in a specific area and neighborhood. So what Foreclosures Daily will do, I believe, and Nancy, correct me if I'm wrong, at least in Florida, where my home state is, it does it by county. And, in Broward County, which is one of the biggest counties in Florida, I mean, I was confined to one specific zip code in a city with dozens of zip codes. So I'm not the ideal sample size, but believe it or even with that small, geographic area, I still found leads, which just shows that, I mean, Foreclosures Daily really hits everything. I mean, their data is very, very accurate, and the wider net you have, the more success you're gonna have with it. And I think when you're investing, and generally speaking, investors are looking to invest in a particular county, that's where it really shines.
Yep, and you're exactly right. It is by county, and I have some of the same thing is that I don't want to market to every county here in the Dallas-Fort Worth area, because there's some counties that I'm just not going to invest in because the houses are just too expensive. So, and the nice thing is that you can pick, and maybe there's 20 leads one week and maybe there's 50, but the thing is it's manageable so that you can work it. And then if you're doing multiple counties, it's just a real, and I love that they have real estate attached. I guess I can't say enough about them. So I've been using them for a long time. And okay, so should we flip? So Greg, should we flip in this uncertainty? If so, how would you like to see us from the perspective of a lender?
First off, yes, you should flip. But you just have to, I'd say this, always look at your numbers and just estimate. I'd say this, if you want to be more cautious than most, just estimate, hey, what happens if the market drops 5%? What happens if the market drops 10%? Just have a little bit more cushion, whether it's reserve cushion that you have in your bank account. Maybe it's just maybe bring you a little bit more money down. Your lender will like that too, by the way. Your lender does not want, I say the biggest factor for us when we look at a deal is skin in the game. Okay, we want to see that a borrower, a client is with us in the transaction. That and I'll tell you why, because back in leading up to 2008, and we can speak to this experience because we were around. 2006 to 2008 was a crazy time. Loan amounts were 120% of the purchase price. So borrowers were leaving with checks at closing. And what we found was that when shit hit the fan, excuse my French, in 2008, the borrowers that were leaving with these checks at closing were the first ones to stop paying. Why? Because their financial investment in the transaction never existed. We found that people that brought money to closing, or even now people that bring 20, 30, 40,000 down at closing, they don't want to lose that. And that gives them financial incentive to stay through and stay with it in the transaction if they hit a roadblock or something happens, or they have to evict a tenant or something like that. So bracing for uncertainty is normal, but being able to hedge against it is the important part. And you can never say no to a profit. And just times where everyone is moving fast, that's sometimes where when somebody's moved, my father always said, when somebody's moving too fast, that's when I slow down. So I wouldn't be hesitant to invest. I'd be careful.
So we have some other questions about terms. So I'm kind of going to list a few things off.
Sure.
So someone asked about, have they changed any lending terms on Florida condos regarding the changes with the 40-year inspections? And then someone asked, do you do 30-year term, or what's the longest term? And then one other that I think will probably go right into that is, do you allow second liens?
Yeah, sure.
Second lien possession.
Sure.
So,
and I want to, and I actually answered another question that I just want to make sure people hear. So Greg as well said that rates are down to 5.5%. That may be true. I was speaking in general terms. And again, I am not, the traditional side of banking and mortgage lending is semi outside of my scope and reach. I will say this though, and I answered it. And the point to be made is that a loan always goes beyond the interest rate. A buddy of mine actually was buying a primary home and he got a rate in the 5s. But what didn't tell the story was that he had to buy down that rate with like a 3% discount fee, So it wasn't a bullet point on the slide, but a cost of a loan always goes beyond the interest rate. This is something Nancy and I actually discussed leading up to the meeting, that you could have a low rate, but if your lender is going to require potentially onerous and over insurance of the property, that's going to drive up your cost considerably. At the end of the day, it's not about the rates, not about the points, it's not about the insurance, it's about everything. What does everything add up to? And you could have a super low rate, especially here in Florida. And I know Nancy had mentioned this in Texas where she is, but insurance has gone through the roof in the state of Florida. And you can get a super low rate, but I'm telling you, if you have a traditional bank financing that, they're going to require wind insurance. They're going to require flood insurance. They're going to require, with a huge deductible, no less. So all I'm saying is that, always look at the cost of the loan, and yes, rates may be low, but 7.5% no points is the same as 5.5% and 2 points. So just always look at the overall cost of the loan. But anyways, that was one question I just wanted to make sure I answered, because I typed it and I didn't ask it before. But anyways.
Yeah, and then people are asking like, okay, so Greg asked, where do you feel most investors finding their deals? Is it through a lead source like Foreclosure Daily? What other places are they finding deals? So we'll get your intake, and I can actually add to this too. So
sure. I mean, I'll tell you this much. There's a lot of different ways to find properties, but almost every single, like if I looked at an investor, like some of the prominent investors that I know in the community, they all use Foreclosures Daily. So I'm not saying to build them up. I'm saying that you need a reliable lead source. Okay, whether it's, if you're in a small little town and it's a local bird dog that you have, someone that drives around and kind of finds the properties for you, so be it. But I think overall, if you're going to be in the business of real estate investing, I'm not talking about doing a property as a side hustle, but if you truly want to do this ongoing, you need an ongoing, reliable source of leads. And that's something that Foreclosures Daily can give you. That's something that a tenured realtor can give you. As I said in my slide, make sure you align yourself with people that have been in this business, because they're going to have the relationships that maybe you don't have, and you can piggyback off of that to find your next deal. I think successful real estate investors do not buy off the MLS. Okay. And they either have a realtor finding them pocket listings, or they find the deal before it gets to the MLS, before it gets to the wholesaler. And that's the difference between being a good deal where you make a little bit of money and a great deal where you make a lot of money.
yes, and I'm going to kind of just piggyback on that, because I agree with everything that you said. You have to have deal flow. You have to have a way to get the deals coming in. But when you have that rolling in, then referrals are probably 25-30% of all the deals that I get, because especially when you're working with distressed sellers, distressed sellers tend to hang out with other distressed sellers. So if you do a good job for them, and then you're going to get referrals. And then being a broker, yes, you get referrals from, I actually partner with a lot of different agents that have, I always say, well, I can buy houses that realtors can't sell, because, they can't be listed on the market and that kind of thing. So, okay, couple more. Someone said, would paying 100% of the rehab be looked at as skin in the game?
Yeah, absolutely. Absolutely. There's two different kinds of skin in the game. I'd say there's at closing skin in the game, and then there's ongoing skin in the game. If I had to choose, like, for instance, if I knew you were coming up with 100% of the repair money on your own, then maybe I would require less of a down payment. But I don't want to be in a situation as a lender, and I know there are a lot of lenders out there, even the institutionals, they want down payment at the time of closing, even if they do give you 100% of the rehab. And that's pretty much the going thought process, meaning, we want you to bring something down at closing. And either you can take care of all the repairs on your own. Some lenders will give you the repairs, but I think it all starts from when you sign on that dotted line. Another anecdote, and it always doesn't happen this way, but we had a borrower, back in 2010, brought $40,000 down. That's a lot of money. Didn't make his first payment, So even then, I feel that logic says that if I bring a decent amount of money down from that point forward, I'm going to be less likely to walk. And that's the logic that we use.
Yes. And I think they ask again about second lien positions, and
depends on the lender. Equitymax does. Okay. But again, going back to skin in the game, we don't want to lend, let's say, 80% of the purchase and then have a seller or secondary lender come with 20%, where on the date of closing, you're not bringing anything. You're bringing nominal closing costs.
Right, to get a
At the,
second lien on the rehab, like you get it, and then
the second lien,
yeah,
the second
Countrywide
lien on
Home.
the rehab is fine with us.
Yes,
That's fine, as I mentioned, but we really do like seeing some sort of financial investment from the borrower when they're signing the loan docs, pretty much.
yes. Okay, now we really are gonna just take one more question. I think this is good because there'll be people watching this that are new.
Yeah, and by the
So,
way, email me. I'm sure I speak for Nancy. Email her
yes.
if you guys have any questions.
Yes, that we don't get to. So we're going to talk about, how do you help? How does Equitymax help and work with new investors? And this person's in central Minnesota. So did you see it? It says she's got the agent. I'm a new agent getting my feet into probate. Right now I'm working to get under contract the house that needs work. How do you work with new investors? By the way, I'm out of central Minnesota.
Okay. Big day for Minnesotans. Anyways, we love new investors. And again, it all varies on who you're dealing with. Given that you're a new investor, you have to find a lender that is okay with new investors. There are a lot of lenders out there that want that experience. Like I said, in the us Equitymax versus the other lenders want you to have 2 flips in the last year or 2 before they even start working with you. Or the rates are going to be increasingly high. The points are going to be high. The LTV is going to be very low. Whereas us, Equitymax, we are fine if you're a new investor. Credit would go specifically for our company. Credit and the type of deal you're working on will go a long way. If it's a completely heavy rehab where you're going to have to go down to the studs, and you have low 600s credit, and this is your first deal, I'm going to tell you, slow down a little. If you have great credit, that to me, even if it's your first deal, and it could be a heavy rehab, that tells me that you find a way to pay your bills. You find a way to make it happen, even in unfamiliar circumstances and situations.
Yeah.
So we work with new investors. Some lenders do, some lenders don't. And again, you got to be able to embrace someone that wants to try something new, because even the prolific investors out there now were at one point new investors.
Yes, everyone has to start somewhere. And the whole point of finding people that you can partner with, lenders, realtors, it takes a village, I don't know too many people that are successful in real estate investing that didn't have a team going with them. They had, good lenders, they had good title companies, they had, leads and things like that. So, well, thank you so much, Greg. One more question. I keep saying this, but it seems like they want to know, do you do new construction loans?
We do new construction. Again, that's something that Equitymax will do it a little bit more conservative loan to value, but we don't require experience. Every other lender almost across the board is going to want to see you as the investor on the selling side of the settlement statement as the one that constructed at least 3 new builds in the last 2 years. They want to see this is something that is your day in, day out. That's something we don't require, but other lenders do require.
All righty. Well, thanks so much, Greg, for your time
Pleasure.
today. Everyone, thank you for joining us tonight.
Email me if you have any questions.
Email Greg, and reach out to your representative with Foreclosure Daily. Everyone have a safe journey, and I hope you all were safe from Debbie. So we didn't even get there, but all right. I'll see you all next month. Bye-bye.
Take care.